In the last week, we've started to see signs of a potential rotation, money moving out of strong sectors like tech and semiconductors and moving into more neglected areas like healthcare, and Nvidia, which has been leading the AI rally, has slipped more than 1%. Now, the real story does ultimately come Wednesday after the market close, where they will be reporting their earnings, and this is going to be absolutely critical, not just for shareholders of the company, but actually the entire market. We're seeing expectations are in fact sky high, and in this video we're going to break down what's been happening, what to watch for over the coming days, the earnings call, and an update on the valuation of Nvidia going into this week. We have to make you aware though, year to date, market looking very strong. S&P, lots of green, which also extends to the semiconductor space. Nvidia up 33%, Broadcom around 27%. AMD actually a surprise alongside Micron Tech have been some of the best performing stocks right across the market. And it wasn't too long ago that Nvidia reached a milestone that no other company had, where they're now sitting at a valuation above $4 trillion. If we have a quick look at their earnings and the expectations, well, over the next 4 quarters, they're still anticipating strong double-digit growth. They've also outperformed against forecasts in the last 4 quarters. That is a 100% track record. Remember, if they do hit their full year accounting for next year, valuation, which we will get onto shortly, is anticipated to drop below 30. And you can see this is a semiconductor company. It is in a cyclical industry. They're anticipating this full year growth around 46%. And whilst it is slowing down, still double digit, but actually analysts are expecting by January 2029 to see single digit growth. So there is still quite a large runway for the company. And to put things into perspective, in the last 2 years, Nvidia have outperformed in every single quarter on the earnings per share, and they've only missed in one of the revenue metrics. So we'll just have a quick look at their performance, but as you can see, earnings per share looking crystal clear, very, very strong. Whilst we might note some marginal beats, overall the message is clear. This is one company that continues to outperform. It's the same thing on the revenue. If you wanted to see where they didn't outperform, you'd have to go to January 2019, and that was only a very, very marginal miss. We're talking 0.4%. $43 million. The other time that we saw that, you'd have to go to January 2011, and that again was a very marginal miss. So message is clear, Nvidia do typically outperform. And if we look at their expectations for this quarter, it sits around 45 billion. Now we will talk about this loss later on, as well as the decline they've been seeing in the China revenue, but margins looking very strong as well. This is one company that really you do not want to bet against if you believe AI is not only here to stay, but ultimately will make things a lot more efficient for companies and ultimately consumers. And we've even seen today analysts are continuing to increase price targets for the company. We're talking over $200. We have Stifle here. They've raised their price from 202 to 212, where they've cited accelerating broad-based demand. We have another popular analyst bringing it up to $225, and this is something we're just seeing. We're talking literally either today or a few days ago. UBS 205, and we also have Evercore here 214. Now, granted, the company has been on a very strong run. They're up 44% actually over the last year. Just in the last 5 years, they're up nearly 1,300%, but analysts believe this is only going to continue to climb, and we can note here all-time highs $184, which they do believe in the coming days it will surpass that. In fact, it's now got a market cap of 4.34 trillion, and Wall Street, as they have done for quite some time, have this at a strong buy, 4.58 out of 5. Now let's briefly cover the valuation. We're on a forward P basis of 36. That is below the 5-year average of 41. Now in isolation, we would call this an undervalued signal, but remember, we never look at this in pure isolation. The other model here, the blue tunnel, which reflects the expected fair price, also gives a slight undervaluation indicator where the current trading price sits just below. Great to see fair price increasing over time, But actually, and surprisingly, from 2025, this company has continued to be in an undervalued signal and is only now reaching a potential reasonable valuation. Something that actually, when we zoom out to the last 5 years, we can see sometimes in a reasonable signal, sometimes overvalued, and sometimes what we would say here, like Liberation Day, severely undervalued. As always, make sure you are subscribed. More importantly, notification bell button is on, because when these companies become severely undervalued, we will let you know. But also, if we want to move away from a forward P and look at a PEG, price to earnings growth, the market as a whole does look very, very high. Ideally, we want to see companies around a 1, where that would be green, indicating great opportunity, but really no more than 2. And that is something we're seeing with Nvidia on a PG around 1.8. So that does mean potential opportunity when incorporating the growth. Just look at other companies, AMD around 3, Broadcom around 4. Micron, we've covered this one before, also looking very attractive on a PG basis. And in their previous earnings, we saw revenue was up 12%. Now, something Nvidia do that other companies don't, that really speaks to the sheer volume of how strong this company is. They compare their performance on a quarter-by-quarter basis rather than year-on-year. So top line is up 12% from the previous quarter. Data center, which we'll speak about later, up 10%. But something investors didn't like to see was deficiencies in their margin. Gross was down double-digit 13 percentage points, operating 12, and their bottom line down 14. Now, this was in part due to the restrictions that were in place not too long ago, not just applicable to Nvidia, but around AI chips not being able to be sold to China. Restrictions were in place, where ultimately they would have needed an export license, and we can see with regards to the numbers they reported, 4.5 billion was relating to charges, excess inventory for chips they were now unable to sell. Otherwise, they would have recorded actually an increase to what we noted of 2.5 billion, and the gross margin, where we just said were deficiencies, it would have, instead of being 61%, for the quarter arrived just a little over 71%. And we can see they've also mentioned this in their investor presentation. They recognize 4.6 billion in the H20 revenue, as well as a write-down of inventory. Data center alone, though, that's up 10% from the previous quarter, 73% from the same quarter last year, Q1 FY25. And now those restrictions have been lifted, although it is a little bit concerning because we've seen the deal to allow this is actually Nvidia alongside AMD will now have to pay around 15% of those specific sales to China to the US government. Not only is it a worry actually for the semiconductor companies that it affects, but also for the wider market, as we may start to see some kind of deals like this that really will take away some returns for shareholders one way or another. And we've also heard a few weeks ago that the Chinese government are specifically telling those users of these chips to avoid them, so this is something also to bear in mind when thinking about this for the longer term. And it may feel like tariffs was such a long time ago, but one thing perhaps we're seeing Nvidia doing to circumvent any future potential issues is that they're manufacturing American AI supercomputers, as noted, for the first time in the US, and that actually within the next 4 years they're planning to produce up to $500 billion of AI infrastructure. And this is ultimately a very fast growing company, at least in the more recent period. 2024 revenue up 126%, last year 114%, and even whilst it is expected to slow down, on a trailing 12 month we're talking 86%. And it's just impressive, as we mentioned earlier, when companies actually compare their figures on a quarter by quarter basis, and this is down to the impressive growth they're seeing specifically in data centers, because whilst they do have other income segments, not all of them aren't in fact growing at all. One though that we do want to highlight, something that's maybe underappreciated and overlooked, is the automotive segment, and this is one that could actually climb quite fast over the coming years, maybe in the more medium term, because a lot of this growth is being driven by self-driving automotives. Because if you're a believer in this for the long-term solution coupled with robotics, then this is one that could also see a lot of growth that maybe analysts aren't forecasting, and their numbers as a whole just look impressive regardless of what metric you look at. For example, free cash flow, this is growing 71% year on year, saw a very large jump from Q4 to Q1, and actually Q1 coming in at 26 billion. If you look at the same quarter in 2024, it was around 15. So in fact, nearly double that. And we can also evidence this from their latest report, We really want to highlight this because when we come to our own valuation, we're going to show two scenarios. So just remember here, 26.1 billion was what they produced in free cash flow in this latest quarter. And we can also look at their bottom line net income. This is also climbing 67% year on year, revenue on a 41% CAGR, and an interesting metric here is their revenue per employee also continues to climb. Now the data center segment is always going to be one that gets the most attention, where we can see it's up 102% year on year, but notice not only has it seen rapid growth, but this is also continuing. Not something we can say for AMD, which actually over the last 2 quarters now on a successive rate has seen decline, and it also produces some phenomenal metrics that you won't be able to see in many companies. The return they're getting on the capital they're putting into the business, well, it's well above the minimum 12% for the industry. It's also been climbing. We're talking 71% in 2025. This metric, typically we just want to see 10% at a bare minimum to give us faith companies can effectively allocate their capital. Their net debt to EBITDA is also very, very impressive. We want below 1.5. It's 0 across the board, 0 expected over the next year, and this highlights the number of years it would take them to pay off all of their debt, so not even one day, really highlighting balance sheet strength. But we'll also just prove that here as well. So we do a quick health check, typically total cash versus total debt, where cash has been climbing 5 billion 10 years ago to now sitting at 54. And as always, we compare it to their total debt because one number here in pure isolation will give nothing away. And their total debt, whilst it has increased over the last 10 years, 1.4 billion, now sitting at 10.3, highlighting their cash is far superior, and as we said, won't even take them one day to pay it all off. Their growth is also very impressive. We highlighted last year looking very strong, expected to continue, and actually it's one of those rare companies, for a growth one in fact, that's growing faster than they have done historically, not something that you do see on a day-to-day basis. They also expect earnings per share over the next 3 to 5 years to grow 30% annually. That's well above the sector at 15 and slightly higher than their 5-year of 29, whilst also being an incredibly profitable company. We're talking gross margin 70%, sector median 49, significantly lower. Even their own 5-year average is lower by quite some way at 66. Bottom line, 52%, sector comes nowhere near, and huge improvement to their own 5-year. This is truly a strong company. Question is, can they keep up the momentum? And cash from operations, 76 billion over the last 12 months. Just look at their own 5-year, so much lower at 22 billion. It's also worth flagging the company continues to outperform when you look at the S&P as well as the QQQ. Is up 44% in the last year, S&P 16, QQQ up 21, and this also holds true over the last 5 years. Neither comes anywhere near to Nvidia being up 1,300%, and the same over the last 10 years, they come nowhere near. Question is, can it continue, as ultimately past performance is not an indicator of the future. And if you're interested in seeing what super investors have been doing in the latest quarter, well, we have here 15 that do hold it in their own portfolio. We had a few, although fairly trivial, actually making it a new buy, as well as others, including the billionaire David Tepper, who's adding to his position. So just a sign super investors are continuing to buy. But it's not just them, it's also institutions with their 65% ownership. They sold 107 billion worth of shares in the last year, but they bought more than 3 times as much at 333 in the same period. And look at Q2, massive amount of buying, 146 billion versus 23 sales. So really highlighting they're very bullish, they're net buyers as opposed to net sellers. And if you want the reverse of the trend where they were more bearish, you'd have to go Q1 2024. Now, just before we move on to our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's going in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then jump into our valuation where, as we said, we have two different scenarios. The first one coming to $164 and the second one also derived from the DCF coming to $234. So we'll cover the first one, talk you through it, and then move to the other. And ultimately, we have the free cash flow year on year. Now, growth just last year, 125%. Over the last 5 years on average, 153. Over the last 10, over 100, 104. Now, we have gone 20%. You could say a little bit conservative. Some might say optimistic over the long term. But as always, we have a low, medium, and high. 15, 20, 25, subjective, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others. But ultimately, 20% growth rate with a discount rate gives us the present value of future free cash flow terminal price, add together with the cash, subtract total debt, giving us the equity value, dividing by shares outstanding, getting to 164, actually indicating downside of 8%. Now, full transparency, we'll show you at 15%, it comes to 116, downside of 35, and those are a lot more bullish at 25%, 229, 29% upside. Also worth flagging, baked in already, if you're adding today, is 21.2% growth to the future free cash flow. If you think that's too high, then already you see it as overvalued. If you believe way too low, then undervalued. Now, typically we like to use the middle rate, so at 20%, you're not actually getting a margin of safety. What this is highlighting is that today you're paying a 9% premium. Some investors won't mind that and will be happy to add. For those that want to see it at the 10% rate, which we typically execute on if it meets our 3 golden criteria, wide moat, strong financial metrics, good forward-looking data, then it's a buy at 147. At 20%, then a buy at 131, and at 25, a buy at 123. But based on scenario 1, we can see here 9% premium. Wall Street, now they expect $205 into next year, 15% upside, but this is purely the average. Some believe a lot higher, as we flagged at the beginning of the episode, well above the $200 mark. Let us know though, this is scenario 1 and we're going to move now on to scenario 2. The difference is here for the 2026 position, we've actually extrapolated, as you can see by the formula, the free cash flow from Q1. So ultimately that is where we land. It could be high, it could be a little bit lower, but these are two different models for those that do prefer for consideration. Growth rates still remain the same. We have gone for 20%. If you believe 15, well then it is downside of 3, but actually baked in is 15.5, so around fair price. If you believe a lot higher at 25%, then 314, 76% upside. Baked in though 15.5, and ultimately this is flagging today a 24% margin of safety. Maybe you believe this one is more appropriate as we are using Q1. Maybe you disagree. Do let us know your views below. Where you see the company, is it one for consideration before earnings? Do you believe it will in fact come down? We also have interest rate potential cuts coming next month, which will play a part in the market overall. Wall Street, their price target remains unchanged, 205. Let us know your overall views. And don't forget to subscribe to the free weekly newsletter. Grab those spreadsheets. Come and join us on Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.